makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. The ECB's Klaas Knot tells Bloomberg exclusively that markets may be underestimating the chances of a rate hike at next week's meeting. The renewed advance in the US dollar is causing concern, with officials in Japan and China threatening FX intervention. Plus, oil near the highest level since November after Saudi Arabia and Russia extend cuts through the end of the year. Now let's take a look at the European markets map, but also I know a lot of kids are going back to school today, so happy back to school day. If you're one of the parents, good luck in sending them back and focusing on the markets. Global debt markets are really bursting with new deals as September kicks in. Now we're looking at the European map. We're seeing a little bit of pressure across the board, but a lot of the focus will be on these global debt markets. Again, a lot of investment grade companies are now rushing to try and lock in some of the borrowing costs before central banks can raise them further. We had about 40 businesses tap some of these high-grade debt markets around the world yesterday ahead of some of the crucial releases of economic data and central bank policy decisions. Now, the other thing we're looking at for is, of course, away from these equities, what's happening with oil. That's giving a little bit of concern out there in some of the equity markets, but it's also dollars. So a lot of the focus today will be on currencies and quite big currency moves that we've seen. Now, the renewed advance, and you can see that on the screen, in the US dollar is really sending Asian currencies to a multi-month low, whilst prompting authorities in Japan and China to step up defense of their beleaguered exchange rate. Now, we had something from Japan issuing the strongest warning in weeks against rapid declines in the yen. And then shortly after, we also heard the Central Bank of China saying that the nation will, or they certainly offered some of the most forceful guidance on record with its daily reference for the yuan. If you look at the dollar in context over the last 12 months ago, you can see we are seeing a little bit of rising, or certainly a little bit of strength, but it's nothing huge compared to what we had a couple of years ago. And then in Europe, July factory orders are out, showing that the third largest drop on record as the ECB tries to balance inflation with growth. Investors, we also had this wonderful interview with the Klaas Knot that our reporter on the ground, Jana Rando, did just moments ago. And some ECB news crossing, of course, the terminal. That governing council member, Klaas Knot, saying that investors are betting against a rate increase from the European Central Bank and that they may be underestimating the chance of a September hike. So we look at July factory orders. We also look at Knot's comments leading to a spike in the euro. And this, of course, is one of the most important things that we need to look at, given we have an ECB rate decision on September 21st. Now, joining us for more on all of this, Sanlam Investment Global Equity Investment Analyst Hannah Gooch-Peters and our Bloomberg Economics Chief Economist Tom Orlik, who's fresh off a plane from DC to come and join us. So thank you both for coming on today. It does feel like there's a bit of a panic moment, Tom, where we don't really know how much more tightening we'll see across the world. And so we also see this extra debt issuance. What are you expecting the Fed, the ECB and the Bank of England to do?
So the Fed, the ECB and the Bank of England, Francine, they have something in common, which is that they're all pretty near the end of their tightening cycle. But there's also some pretty important differences. In the United States, we've had what we think is the kind of illusion of strength over the summer, a kind of mirage of robust growth driven by some pretty unusual things. The Barbie film, the Oppenheimer film, the Taylor Swift tour, the Beyonce tour, huge spending on these things, boosting GDP, boosting growth over the summer. We think that's going to fade pretty quickly. We don't think the Fed has anything else to do. European Central Bank, well, we just heard, as you mentioned, from Klaas Knot this morning, suggesting the markets maybe are underpricing the risk of a hike at the September meeting. We agree with that. Clearly, it's a close call, but on balance, we think probably another 25 basis points. Bank of England, unfortunately, in the worst of all worlds, inflation from commodity prices, inflation from tight labour markets, we think the BOE still has 2 more hikes to deliver.
When you look at the ECB, is there a concern, and I know a lot of central banks are frustrated, right, that we look at their every move, and I know it's extremely important for a lot of the currencies, but does it make a difference to your world, in the equity world, if there's a 25 basis point hike in September, or whether they wait until next year?
I actually think the uncertainty really adds a lot of excitement to our world. At the end of the day, we're bottom-up equity investors, so if there's uncertainty and volatility in the market caused by this, then that's only good for us. It's good for us to be able to buy into stocks at better valuations. So, I'm welcoming a bit of volatility in the market to be able to do that.
Okay, a little bit of volatility, if you like that kind of, excitement, or if you're on the right position of the trade. Tom, when you look at the ECB, I don't know whether it's more, better to wait and see what they've done so far and how that impacts. How much is a lagging effect? Do we know yet?
So monetary policy, famously, as Milton Friedman said, operates with long and variable lags. I'm not sure the ECB is going to have the patience to wait for those long and variable lags. Yes, there's evidence that growth is coming off the boil. You mentioned the factory orders data. We've also seen the PMI data. But inflation remains way above the ECB's target. Inflation expectations remain sticky at an unacceptably high level. It is a close call at the September meeting. We heard Not say that. But on balance, we think they're not going to be patient. They're going to deliver that final 25 basis points next week.
It feels like European inflation is stickier than in the US. Is that because of oil and energy prices?
So I think the inflation stories in the US and in Europe are a little bit different. In the United States, the problem they have there is very tight labour markets driving wages high. Now, that's actually a bit of a more difficult problem to deal with than what the European Central Bank has, which is primarily a problem driven by commodity prices, the supply side, the impact of war in Ukraine.
Hannah, what does it mean for where you want to be positioned in Europe?
I think that what you want to do is to make sure you're investing in companies that you can benefit from the impacts of inflation. Companies like Visa, so consumer spending increase with inflation because, of course, everybody's spending more money. We're actually really interestingly seeing, in sort of luxury parts of their spending, in travel, in hotels, for example. Management keep talking about how people are continuing to spend more despite an inflationary environment. So if you're looking for companies like that, they're benefiting payment companies and also companies that are just of a high quality and able to pass through these price increases through to their consumers. So inflation is not always a bad thing for high quality companies.
And this is in Europe or overall, almost worldwide, Europe and US?
I think you've got to look for things that have got a global revenue stream at the minute. I mean, I'm not too concerned, to be honest with you, where companies are listed. It's more about where they generate their revenue. And a company like Visa, for example, will have a lot of revenues from Europe, but also globally.
Tom, are we underestimating the fact that actually the consumer is quite strong because first they're relying on savings that they had during COVID, but there is also an appetite to spend, maybe because as a factor post-COVID?
So I think there was certainly that revenge spending motivation as economies came out of lockdown. And in many countries in the US, in many countries in Europe, households also had a lot of pandemic stimulus savings in which to spend. I think what we're seeing now, especially in the United States, is that story really coming to an end. If you do the numbers, if you look at how much excess saving households still have in their bank accounts, really it's significantly depleted. And for many households, that savings gone. You've got interest rates rising, which means that consumer credit is getting more expensive. And with labour markets softening, you've got wage growth coming down. So do we think consumption is going to fall off a cliff? Absolutely not. But that summer mirage, we think, is going to fade, and consumption growth, we think, will fade with it.
Yeah, and concerns about China, which you're a bit of an expert on.
So China is the kind of the dog that hasn't barked yet for the US and for Europe. If you read the headlines out of China, it's a pretty dire situation. You've got the real estate sector, which is the biggest single driver of growth in the Chinese economy, or at least was the biggest single driver of growth, now swinging into reverse. Pretty steep declines in real estate sales and construction, and that's now spilling across the economy, spilling across the financial sector. So some pretty serious concerns about China growth. What we haven't seen yet so far is concerns about that spilling into contagion for the US and Europe. That's possible in the months ahead. We're not there yet.
Hannah, how does it impact, for example, luxury spending?
So a lot of the luxury goods companies have a big sort of kicker, if you like, from the revenue from China. So if you take an LVMH, for example, I mean, you've got sort of 30-40% of their revenues can be impacted from China. A really good example, actually, a high-profile example, is Estee Lauder, which shows if management execute poorly in that part of the world, it can really have a detrimental impact on the share price. It's down probably close to 60% from its peak, which is quite sort of, unheard of for a company of such high quality. So I think you just have to be mindful of valuations. But at the same time, when that Chinese, sort of consumer spending, the travel aspect kicks back in again, I think that you could actually get a really good sort of growth driver from those companies, because there's been very good data historically to show that growth in that area, in the luxury goods market in particular in China, is exceptional, sort of double-digit compound growth, close to 20% over the last 10 years.
Okay, Hannah, thank you so much. Sanlam Investment, Hannah Gooch-Peters and Tom Orlick of Bloomberg Economics both stay with us. We'll have more on global markets. We'll also talk about currencies and, of course, oil. We'll talk all of that with them both next, and this is Bloomberg. The conversations that matter, the insights you need. This is The Pulse. I'm Francine Lacqua here in London. Now, still with us, Bloomberg Economics Chief Economist Tom Orlick and Sanlam Investment Global Equity Investment Analyst Hannah Gooch-Peters. Now, this is a big number. And actually, I'm kind of giggling because Tom reminded me that they used to do this on Sesame Street. So it's like Sesame Street, but for geeks. This is the pump price in U.S. that's hit the highest seasonal level since 2001. And it's $3.81. And this is, look, it's the driving price. It has a huge impact on consumers in the U.S., Tom. And it also comes on the back of the fact that OPEC plus, the two leaders, Russia and Saudi Arabia, have decided to, cut their supplies for longer. So we knew by how much they would cut, but we didn't know the timeline on this.
So it's interesting, Francine. I think you've got some pretty powerful conflicting forces moving energy prices in the months ahead. On the one hand, you've got the demand side, and our view is that if you look at the big drivers of energy demand, if you look at the US, if you look at China, then you're going to see that coming off the boil. We still have a recession forecast for the US in the fourth quarter of the year, and of course China, because of that real estate collapse, growth there isn't that great either. So on the demand side, you've got some pressure for energy prices to come down. On the supply side, though, you've got this kind of newly empowered producer cartel, right? You've got Saudi and Russia and OPEC saying, no, we're going to put a floor under this. And it'll be interesting to see how that dynamic plays out.
Yeah, and how does this dynamic actually impact some of the stocks that you like?
You know, what's really interesting is actually if you look from the end of July, you've got the energy sector up about 10% in dollars and tech up sort of 1%. So we've seen a sort of somewhat of a stealth rally. So what you're saying is being reflected in the markets. Ultimately, it's a very small part of the equity market. And if you'd actually owned a basket of these energy stocks over the past 10 years, you would barely be looking at a positive return. And actually, all of that comes from reinvestments of dividends. So for a high quality based investor, it's actually a part of the market that you've done well avoiding over the long term.
Hannah, I know you like some of the big stocks. I think you reduced your position, Microsoft, actually heavily adding to the position earlier this year, but I think you still like Johnson & Johnson, Visa, and Novartis. I don't know whether the ARM IPO and the fact that they now managed, or they're putting it out there for half the price of which they wanted just a couple of quarters ago. Does that change your perspective on tech?
I think that the big call you have to make now is selectivity in tech, because a lot of it is looking very expensive. We talked about how we've reduced our Microsoft position. That's because of the increased capital expenditure behind investing in artificial intelligence puts it on about a 2.9% free cash yield for next year. So I think there may certainly be a pause for breath in the market, and there's a lot of that investment. Companies like Nvidia, even in companies like Alphabet, for example, they're putting this heavy investment in behind this technology. It will surely benefit long term, but we have to be mindful of valuation now, especially if we're looking towards returns for the rest of the year.
Tom, we also have, this renewed advance in the US dollar is sending shockwaves in Asian currencies to a multi-month low, and we heard from PBOC, and we also heard a couple of, I guess, shots of warning from the Bank of Japan. What does it mean? Does it, disorder the world if there's going to be a kind of, trip to the bottom?
So it's interesting. I think for China and also for Japan, currency weakness is actually a positive, right? You've got China struggling with this huge blow to domestic demand from the real estate collapse. What do they need to offset that? Well, they need exports to do better, and a weaker yuan helps with that. Japan wants to reflate the economy, wants stronger growth drivers. A weaker yen helps with that. What they don't want, though, is a kind of disorderly, sudden collapse in their currencies, right? So a bit more weakness over a period of time, fine. A sudden collapse over a few days, not fine. And I think the PBOC and the Bank of Japan the PBOC and Japan's Ministry of Finance are now signaling that.
Yeah, you're right. So I said it wrong. It wasn't Bank of Japan. But is it something that the Fed is aware of? I mean, they're not central bank to the world.
So, I mean, the Fed, I think, relative to, let's say, 20, 30 years ago, where the mantra from the Fed was, it's our dollar, but it's your problem, I think the Fed is a little bit more sensitive to those global spillovers. But for Powell and co., the focus remains predominantly on the US economy. They're going to do what they have to do to get inflation back to 2%. If that means staying higher for longer and a stronger dollar, so be it.
Hannah, when you look at some of your top conviction calls, is there anything in Asia that could be a buy right now?
So one of our top performers this year is a company called NetEase. They offer sort of mobile and online gaming. They're up close to 40% this year. We still think there's a good margin of safety in that name. They're expanding internationally, and I think for the level of growth you get versus particularly developed markets and in the US, the valuation sitting around sort of 6% free cash yield is very compelling for that growth opportunity and that international expansion you get in a company that's got billions of dollars in net cash on the balance sheet too, so we don't have to worry about the rising cost of debt.
All right, Hannah, thank you so much. Sanlam Investment Global Equity Investment Analyst Hannah Gooch-Peters and our Chief Economist at Bloomberg Economics, Tom Orlick. Now, coming up ahead of the G20 summit in New Delhi on Friday, we'll also look at how India is working on boosting its infrastructure and economy. That's next, and this is Bloomberg. Conversations that matter, the insights you need. This is a Pulse. I'm Francine Lacqua here in London. Now, this year, India surpassed China as the world's most populous nation and now says it's on a mission to build, energize, and connect its vast nation. Ahead of the G20 summit being held in Delhi, Bloomberg's Menka Doshi takes a look at India's infrastructure landscape.
India's longest sea bridge has been some 20 years in the making. It's expected to open to traffic between Mumbai and Navi Mumbai sometime later this year. The connectivity will redistribute the burden and opportunities of rapid urbanization. Infrastructure building has gathered speed across cities and villages, with the government spending record amounts on transportation, power and housing projects to meet urbanization needs, boost jobs and growth, and to cut logistics costs. India needs trillions of dollars in infrastructure spends, currently supplied by government and multilateral institutions. The opportunity to move, house, power, connect, and transact with 1.4 billion people has drawn corporate investments from local giants Ambani and Adani to international majors Brookfield and Macquarie. But private participation, at less than a third overall, has varied based on sector, policy and risk. Telecommunications and aviation are mostly private-owned, but with many financial failures. Airports, ports, power, and now new energy are both under public and private ownership. Railways are mostly government-owned, whereas in roads and highways, past bankruptcies have prompted the government to take on construction risk. Lack of long-term financing, difficulties in land acquisition, and even a shortage of civil engineers in a software-obsessed country are all reasons for chronic delays and cost overruns. Half the projects under construction right now are behind time and over cost. Then there are the challenges of quality, safety, and sustainability. India has the world's second largest road network, fifth largest metro network, and third largest construction market. Yet, over 3/4 of the India of 2050 is yet to be built, says McKinsey. That will likely provide opportunities, but many challenges as well.
Bloomberg's Menaka Doshi there in Mumbai, and we also have a great big take that really focuses on India and India's moment. The title, actually, of this wonderful essay is looking at the G20 summit in Delhi, set to showcase Modi's attempts to demonstrate that geopolitics goes beyond the US and China. Then we also have to look at Manchester United, or United for the fans, as they call it, pre-market. This was the only story that everyone was talking about yesterday. So yesterday, shares fell by a record amount after a report in the Mail on Sunday that said the Glazer family is going to take the club off the market after failing to receive offers that match their asking price. So yesterday there was quite a big drop, at some 18% lower. Today, gaining 0.8%. Coming up, we'll be speaking exclusively to the chief executive of Zurich Insurance, Mario Greco, on the pressures facing the sector. That's coming up shortly, and this is Bloomberg. The ECB's classic note tells Bloomberg that markets may be underestimating the chances of a rate hike at next week's meeting. The renewed advance in the US dollar is causing concern, with officials in Japan and China threatening FX intervention. Plus, oil is near the highest level since November after Saudi Arabia and Russia extend cuts through the end of the year. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, the global insurance sector faces a number of headwinds, with insurers having to navigate persistent inflation, the impact of extreme weather, and of course an uncertain economic outlook. Now, to discuss the pressures facing the industry, I'm very pleased to be joined for an exclusive conversation by the chief executive of Zurich Insurance Group. He's Mario Greco. As always, thank you so much for joining us. Mario, first of all, when you look at the outlook for the rest of the year for insurance, finance income and expenses, what's it looking like?
It's looking better. I understand all the challenges we face, but we've been preparing for these challenges for a number of years. We especially, but the whole market has. And so the inflationary situation is actually helping us going from negative rates to positive rates. Climate can be managed, and there are a lot of services that we can provide to customers to prevent and to mitigate the consequences of climate. And yes, there are new risks, cyber, the most important one. But we're prepared, and so I'm looking with optimism to the end of this year and then the next years.
What's your biggest concern? And I mean, you beautifully laid out some of the challenges, but also some of the opportunities. Is there one thing that keeps you up at night?
Yeah, these are all the things that we haven't been preparing yet. What we experienced over the past years is that there is always something new that it's coming as a surprise. I mean, we had the pandemic, and then with the recession, the inflation, the war, risk of recession again. You can really anticipate for these things. And so you need to react very quickly. You need to keep your organization very alert and reactive. And if you do that, then you can thrive and you can keep growing and you can really do your service to the economy and to the customers.
As you beautifully said, I mean, higher interest rates is not necessarily a bad thing, right, for your sector. Yeah. But is there a limit to, I don't know if you have a sweet spot for when, if interest rates are too high, then it also could kill demand?
I think the limit is the GDP growth. It is recession. If by driving the rates high, the central bankers drive the economies down into a recession, this is clearly not healthy at all, and we will suffer. But we're used to work in even high inflation situation. We've been working for years in Argentina. We're working for years in countries which have high inflation. We know how to do and how to deal with that, as long as the GDP keeps growing.
Mario, when you look at the weather patterns, I mean, they're absolutely unbelievable, and especially in the last 8 months. Are they just going to get worse and worse, and what does it mean for insurance premiums?
Yeah, I'm afraid to say so, but I think we're at the beginning. I think we have initiated a path that will be hard to stop now, and we can only prevent and mitigate along this path and help the people managing this. But yes, I do think this is going to get worse even quickly, and we need to be used to that. And there are different ways in which you can look at. I mean, warm weather will become very hot weather. Rainy days will become flooding days, and cold days will become icing days. And so there is a lot to do to help the society preventing and preparing for that, and then mitigating the consequences.
But how do you mitigate something as big and as formidable as some of the fires that we've seen over the summer?
Prepare. I mean, once the fire starts, you just have to, put water on it. But it's late. You have to prepare. You have to anticipate. We've been, working even with cities in Europe to prevent the effect of warming on these cities. This is the things you have to prepare and do, many years before they happen, or many months before they happen. When they happen, you just it's emergency care, and you do whatever you can.
But does it mean, Mario, that there are some things that you won't insure anymore?
I don't think climate will ever become uninsurable. It can become expensive, but no, I think we will continue to provide, and the customers need that, and both our retail customers, the individuals, and the companies need that. So we will continue to provide coverage, but the coverage will become expensive. Yeah.
You also withdrew from the Net Zero Climate Alliance. Is it because this was flawed?
No. I think the issue there was that this was born to be a global alliance, and it ended up being just a European one. Yeah. And then the second point is that I believe that we have already passed the point at which we need all these alliances. We are in a situation today where the political support and even the societal support to climate is dubious, right? And so you need to stand by yourself on what you believe for. You can't hide behind alliances. You need to take your own decisions, and you need to represent yourself in front of the customers, shareholders, stakeholders, and say what you believe in. Yeah. And this is what we're doing, and we will progressively do it also for other kind of alliances, because more and more we feel an individual responsibility to that.
But does it make it more likely for competitors to follow you, or is it also easier for companies to just drop off and no one ever hears from them again?
I don't know that. We need to see it. I mean, for sure, what I feel today is that there is much less political and government support on these issues. And so you need to learn how to walk by yourself and speak to your customers and to your stakeholders with your own voice, and present the things you believe on. I mean, and just take your responsibilities for that.
Mario, when you look at the catastrophe-linked losses, how are you expecting those to do actually in the second half of the year? That's impossible to say?
Yeah, that's a billion question. I don't know. I mean, what I know is that over the past years, we had many more events with pretty much an average severity. So that's all I know about it. If I look past, I would expect many more events that we would like to have with an average severity of them. Is this going to be the case over the next months? I don't know. I mean, predicting weather is almost impossible.
It's impossible. How does it change, though, your industry in 3 to 4 years? Are we underestimating the deep impact of actually what some of your companies will become?
Yeah, I think the industry needs to have a very strong capital position, as we do have. The industry has to accept that there will be more and more volatility because of these weather events, and we need to prepare and react to that. And this more and more becomes a job for big shoulders, for big companies, which again, we are prepared for that. But I don't think we are optimistic on what's going to be the weather-like impact over the next years. I think we're prepared for what that's going to be, and we've been preparing now for years.
Mario, when you look at Zurich, is there anything more that you want to sell? I know you sold a couple of small things to Viridium. Yeah. Are you now looking to buy? Is there going to be any more adjustments that we should be looking at?
Yeah, I mean, the life sale actually have a story, because it all started in the first months of pandemic, where we saw our capital ratios moving downwards because of this very old closed books of life, which still had the capacity to impact our solvency ratio. And in those days, we said, no more of this. We want to protect. In a tail event situation and bad things happen, we don't want to be in the same situation as we are. I think we've done everything we planned to do in those years. Now our tail risks are very well mitigated. I think our shareholders can feel safe with that. Our capital is very well protected, even in tail events. And that's all we wanted to do. But it took us 3 years to get to what we wanted to achieve.
Mario, when you look at life insurance in general, I don't know whether that contract, right, has changed at the margins because of COVID. Have you seen any patterns or shifts or changing behaviors?
Yes, I think all of us are much more aware of our health and how thin is, our life on this planet than we were before COVID. And we see that, in the interest for protection policies, for health coverages, for well-being coverages. Yes, it's a remarkable shift in customer preferences. Before COVID, you needed to convince the people. After COVID, they come and ask, how can I better protect myself and what else can I do? Also, they search for advice. And it's a good sign for us.
Mario, as always, thank you so much for joining us. That was Mario Greco, the Chief Executive Officer of Zurich Insurance Group. Now, coming up, we'll also be speaking to the acclaimed economist, Mariana Mazzucato, on why she believes putting growth at the center of economic policy is a mistake. That's next, and this is Bloomberg. The conversations that matter, the insights you need. This is The Pulse. I'm Francine Lacqua here in London. Now, my next guest is the author of 4 highly acclaimed books. She advises policymakers around the world, and she's, of course, a leading academic. This week sees the publication of a 10th anniversary edition of her book, The Entrepreneurial State, Debunking Public versus Private Sector Myths. Now, here's a spoiler alert. It contains a new preface looking at what's changed a decade on. Well, Mariana Mazzucato, thank you for joining us and welcome to Bloomberg. It's a great book. It's a controversial book, not a book that a lot of governments, or some governments, want to take to heart. Not a lot of CEOs want to take to heart. What's changed in the last 10 years?
Well, the reason I wrote it 10 years ago was that after the financial crisis, which in my view was caused by private debt, not public debt, we went on this massive wave of austerity, which we're still bearing the consequences of that, right? Because there was a lack of investment and all the things that actually drive stronger
especially
social
in the
fabric.
UK.
In the UK, but actually across Europe. Okay. Across Europe, a lot of the loans and the recovery funds back then were conditional on countries obsessing about their deficits, right? You're right, though, less in the U.S., which is interesting, right? That goes against some of the stereotypes that we think the U.S. is more market-driven. Actually, it was Europe and the UK that really embarked on that. And my point of writing it was that if we actually want to recover, all these words about recovery, of course, are very much used now, but they were used back then, and doing so by cutting public budgets kind of doesn't then pay respect to what we know about long-term growth, especially innovation-led growth, right? Because that's what we care about. We care about investment-led growth, innovation-led growth. In the UK, for example, even pre-kind of COVID, most of the growth happened through consumption-led growth, mainly fueled by private debt. So the ratio, even today, of a private debt over disposable income continues to be way too high. And when that bursts, we'll have another financial crisis. So the book said, invest, 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 but take care on how to do that. Right. We need to invest in research and development. We need to invest in the capacity.
So through the government, right? Your premise is that the government can do more, whereas at the moment, it's just kind of given it to private companies to get on with it.
Exactly. It's always about public and private. The book also really talked about going beyond the ideology, that it's either state or the private sector. It's about how do we work together? How do we get to the moon? That, of course, was my other book also called Mission Economy. But already in the entrepreneurial state, I said, we need partnerships, but we need symbiotic partnerships, not parasitic partnerships. But we don't need state funds just giving guarantees and subsidies to the private sector. We need conditions, for example, on what that means. So instead of just giving money today, for example, to the semiconductor industry through the CHIPS Act in the U.S., I've been talking to the U.S. government on the lessons of the entrepreneurial state on what would it mean to actually embed within the CHIPS Act conditions on making sure that workers are paid well, working conditions are good, green procurement is used, and also that the profits generated are reinvested.
You advised, right? The Commerce Secretary.
Gina Raimondo, the Secretary of Commerce.
So what does that, are we getting in a place where you think is more comfortable than it was 10 years ago?
Look, there's so much variety, right? There's different ways to do capitalism. There's not one way. So think about what happened during COVID in France. All the bailout money that went to companies like Air France and Renault were conditional on those companies investing in reducing their carbon emissions. What do we do in the UK? 600 million to EasyJet, no conditions attached. In the US, we have the Inflation Reduction Act, the CHIPS Act, we have the coronavirus recovery program. And if you look at how much money is actually being put into the economy, it's huge. It's 4 trillion, over 4 trillion. But that's not enough. We shouldn't just have helicopter money. Right. We need to make sure it lands on capable structures that can govern the solutions to the biggest problems we have: climate, health, digital divide. That requires
Mariana,
governance structures.
Why are some governments then, doing it right in your eyes, and others not, without any conditions attached?
Well, leadership matters. I'm currently working also, for example, with the Prime Minister of Barbados, Mia Mottley, who personally I think is one of the most inspirational leaders today. But I'm also talking to Lula, of course. I just came back from Brazil. And the question there is, when you have a leader who has a progressive agenda, and progressive versus regressive, and actually steering growth, because growth has not just a rate, but a direction. How do we get inclusive growth? How do we get sustainable growth? How can we transform the 17 sustainable development goals that every country has signed up to into what I call moonshots?
Something actionable.
Concrete moonshots, right, with an investment trajectory.
How's the UK doing?
Well, what's really interesting in the UK is just the inertia, not just in the economy, so productivity is lagging, but in the discourse. And unfortunately, even the opposition, so the Labour Party, which everyone's saying is going to win, they seem to be kind of knee-jerking, reacting to what the Tories are doing and what the Tories are saying. And instead of both of these parties saying, okay, how are we going to have a dynamic economy? How are we going to work well with business? How can we actually turn the challenges of the UK into investment opportunities, innovation opportunities? They're almost competing on who sounds more kind of, stable and rational about the finances, which, of course, we have to care about the finances. But the irony is, when you obsess about the finance, when you obsess about the deficit, what ends up happening? Your debt to GDP rises. Why? Because you're not actually making those investments that are long-run drivers of the denominator of the ratio, GDP.
But Mariana, why is that? Is it because they're going from crisis to crisis, i.e. the schools and the concrete that has had to shut them down? Or is it they're remembered about what happened a year ago with the very brief Liz Truss government and say, actually, we want to be on the market side?
Yeah, but we had already experienced that before, right? I mean, if you think of what happened in the previous election and how the narrative almost just didn't talk about, again, the big problems of our time. So yes, Liz Truss made it much, much worse because now the cost of living is worse than in other places because of what happened to interest rates and so on. But, the fact that we're not investing in public education and public transport and public health, schools are crumbling, town halls are crumbling, is depressing. I mean, it's not only bad for the economy, it just makes everything quite negative. And, what drives business investment, if we just think of the business side, not just the humanity and citizenship side, is expectations about future growth opportunities. And what happened with Brexit is the market size of the country fell drastically. So forget what we think about it politically, economically, reduce the size of the market. And many businesses stopped investing, foreign businesses, but even national businesses in this country.
Who's to blame for all these crises?
Definitely the lack of leadership. But also, the media, to be honest, I think is also often just nitpicking on numbers. Oh, today growth went up, growth went down, as opposed to what do we know about the social fabric? What do we know about the long-term growth? So both the politicians, but the narrative and, holding the media accountable to not kind of keep repeating the myths of kind of bad economics and actually making sure that politicians, when they are on an electoral campaign, are actually talking about what matters to people and planet. I think it's going to be very important for this country in the next months.
Mariana, thank you. Coming up, we'll continue the conversation with author and acclaimed economist Mariana Mazzucato. It's also a fantastic book. You agree or disagree, but everyone should read it. We'll be right back, and this is Bloomberg. Still Still with me, author, policy advisor, and professor in economics, Mariana Mazzucato. Mariana, so your book, The Entrepreneurial State, came out 10 years ago. It has a new preface, and it's coming out again this week. Talk to me a little bit about Apple. You dedicate a whole chapter in basically dissecting how Apple was formed, and what does that tell us about the entrepreneurial state?
Yeah, so the reason I had the chapter on Apple is that when people think of the United States, they think of free market, and yet all the kind of big innovation that occurred in the U.S. was actually co-funded, if not actually financed early on by the state. So everything that makes our smartphones smart, not just the iPhone, is the internet, GPS, touchscreen, Siri, all government financed. Now, that's a nice part of the story. That's business and government working together. What's not so nice is when we end up socializing the risks and then privatizing the rewards. So how much of the profits that have been generated from the internet revolution or today from big tech have been reinvested back into the economy, making sure public schools are strong, et cetera. So that's where the idea of conditionality comes in. When you have an ultra-financialized business sector where over $7 trillion have been used in the last decade on just buying back shares to boost stock prices, stock options, and executive pay, that's a bad deal. Right, so Mariana, the negotiation between public and private.
So concretely, what do you need? Do you need more people in government who can negotiate contracts with privates?
You need two things. First of all, you need an innovation system. That's the bit the U.S. did quite well. We had the Defense Advanced Innovation Agency called DARPA. They were, in fact, responsible for investing in the internet. We have the National Science Foundation. We have public venture capital funds. The CIA has one, by the way, In-Q-Tel. We have downstream, bold, outcomes-oriented procurement. So that's one part of the story that the world needs to learn. Dynamic innovation systems with public institutions distributed across the whole innovation chain, working with the private sector. But the second part of the story is where it goes wrong. What does it mean along the way to negotiate? What does it mean to actually invest also within our public administration so that also know how to negotiate, but also know their worth? I often say that I walk in as an economist and I come out as a life coach. I'm like, come on, man.
Okay, but who's doing it right?
Well, first of all, there's no one country that's perfect, but if we look at, for example, what happened recently in Germany, where because they had a very clear energy strategy, they made sure that the loans going to a sector like steel, which globally is asking for bailouts, was conditional on that sector reducing its material content of production. That's why we have green steel in Germany and in Sweden. So what I'm interested in is examples where a particular public institution, whether it's an innovation agency or public venture capital fund or public bank, doesn't just subsidize and guarantee, but actually negotiates. And by the way, the reason we ended up with Bell Labs in the US, which was critical to the IT revolution, was the government actually forced AT&T at the time to reinvest its profits back into a big innovation agency. And that's where we got Bell Labs.
Mariana, thank you so much. Mariana is also joining us on the podcast, author and professor in the economics of innovation and public value at UCL, Mariana Mazzucato. Up next, Bloomberg Surveillance Early Edition with Sonali Basak in New York and Danny Berger here in London. And this is Bloomberg.